Question 1. Term life insurance characteristics. Which of the following best describes a decreasing term life insurance policy? A. The face amount remains constant throughout the policy term. B. The premiums decrease as the policyholder ages. C. The face amount decreases over the term of the policy, often in relation to a debt repayment schedule. D. The policy can be converted to a whole life policy at any time during the term without evidence of insurability. Answer. C. The face amount decreases over the term of the policy, often in relation to a debt repayment schedule. Explanation. Decreasing term life insurance is designed so that the death benefit decreases over the life of the policy, typically aligned with the decreasing balance of a financial obligation such as a mortgage. This makes it an appropriate choice for individuals who wish to cover specific debts. Option A is incorrect because it describes a level term policy. Option B is also incorrect as the premiums typically remain level throughout the policy. Option D pertains to convertible term policies, which allow conversion to permanent insurance, but does not accurately describe decreasing term policies. Question 2. Underwriting process. During the underwriting process, which factor is least likely to influence the premium rate for a term life insurance policy? A. The applicant's occupation and lifestyle choices. B. The applicant's health history and medical examinations. C. The applicant's gender and age. D. The applicant's choice of beneficiary. Answer. D. The applicant's choice of beneficiary. Explanation. The choice of beneficiary generally does not affect the premium rate of a term life insurance policy. Underwriting primarily assesses risk based on factors that impact life expectancy, such as health history, age, gender, and lifestyle choices. Option A, B, and C. These factors help insurers determine the likelihood of a claim being made and subsequently influence the premium amount. Since the beneficiary is simply the person or entity designated to receive the death benefit, it does not inherently change the risk associated with the insured person. Question 3. Scenario-based question. Mr. Thompson, a 45-year-old non-smoker, is considering purchasing a 20-year level-term life insurance policy. He has a family history of heart disease but is in good health himself. After obtaining quotes from various insurers, he is presented with two options, one with a higher premium but favorable underwriting criteria and another with a lower premium but more stringent medical requirements. What should Mr. Thompson consider most when making his decision? A. The low premium, as it is more affordable in the short term. B. The insurer's reputation and claims settlement history. C. The underwriting criteria of the lower premium option, which may affect his eligibility for coverage. D. The length of time the policy will be in force, focusing solely on the premium difference. Answer. B. The insurer's reputation and claims settlement history. Explanation. While cost is an important factor, Mr. Thompson should prioritize the insurer's reputation and claims settlement history. Option B. This ensures that, should the need arise, his beneficiaries will receive their benefits without unnecessary delays or complications. Although a low premium option A might seem appealing, if the insurer has a poor reputation or a history of claim disputes, it could lead to significant challenges later on. Option C, while relevant, focuses too narrowly on eligibility without considering overall service quality, and Option D overlooks the importance of reliability and trustworthiness in a life insurance provider. Therefore, comprehensive due diligence on the insurer is crucial for Mr. Thompson's decision-making process. Question 4. Consumer protections. Which of the following statements accurately reflects the right of policyholders during the grace period of a term life insurance policy? A. The policyholder has no rights during the grace period and must pay the premium immediately to maintain coverage. B. The policyholder retains full coverage during the grace period, and any death that occurs will still result in the payment of the death benefit. C. The policyholder may receive a partial refund of premiums if they cancel the policy during the grace period. D. The policyholder can change the beneficiary designation at any time during the grace period without restrictions. Answer. B. The policyholder retains full coverage during the grace period, and any death that occurs will still result in the payment of the death benefit. Explanation. During the grace period, typically ranging from 30 to 31 days, the policyholder retains full coverage, meaning that if the insured person dies during this time, the death benefit is still payable, albeit minus any unpaid premiums. Option B. Option is incorrect, as the grace period specifically provides a time for the premium to be paid without loss of coverage. Option C is misleading, since refunds typically occur only upon cancellation of the policy, not during the grace period. Option D is incorrect because while a policyholder can usually change the beneficiary designation, some insurers may have specific rules about changes during the grace period. Question 5. Term policy features. What is the primary purpose of a convertible term life insurance policy? A. To provide a higher death benefit as the insured ages. B. To allow the policyholder to convert their term policy into a permanent policy without additional underwriting requirements. C. To decrease the death benefit over time in accordance with a mortgage repayment schedule. D. To allow for adjustments in premium payments based on market conditions. Answer: B. To allow the policyholder to convert their term policy into a permanent policy without additional underwriting requirements. Explanation: a convertible term life insurance policy allows the policyholder to convert their term insurance into a permanent life insurance policy without having to undergo further medical underwriting. Option B. This is a significant benefit, especially for those whose health may decline over time. Option A does not apply to term policies, which generally have fixed death benefits. Option C describes decreasing term insurance, and Option D does not pertain to term insurance policies as premiums are typically fixed. Question 6. Premium calculation. When calculating premiums for a term life insurance policy, which of the following factors is typically considered most critical by underwriters? A. The insured's occupation and hobbies. B. The insured's geographic location. C. The insured's family history of diseases. D. The insured's marital status. Answer: C. The insured's family history of diseases. Explanation: while all factors listed can influence underwriting decisions, the insured's family history of diseases, option C, is considered one of the most critical factors because it can indicate potential genetic health risks that may affect life expectancy. Underwriters closely evaluate such histories to assess risk accurately. Option is also important, but occupations and hobbies are typically secondary to medical history. Option B, geographic location, may have some relevance, particularly with regard to healthcare access, but it is less significant than family history. Option D, marital status, is not usually a significant factor in premium calculation. Question 7. Claims process. Which of the following best describes the contestability period in life insurance policies? A. A time frame during which the policyholder can cancel the policy for a full refund of premiums paid. B. A specified period, usually 2 years, during which the insurer can contest or deny a claim based on misstatements made in the application. C. A duration in which the insured must inform the insurer of any changes in health status to maintain coverage. D. A time frame in which beneficiaries can file a claim without providing any documentation. Answer: B. A specified period, usually 2 years, during which the insurer can contest or deny a claim based on misstatements made in the application. Explanation: the contestability period is typically 2 years from the policy's effective date, during which the insurer has the right to contest claims if they find misrepresentations or omissions in the application. Option B. If a claim is filed after this period, the insurer usually cannot deny the claim based on inaccuracies in the application. Option A refers to cancellation policies, not contestability. Option C is misleading, as while notifying changes in health can be important, it does not specifically define the contestability period. Option D is incorrect because beneficiaries must provide appropriate documentation when filing a claim. Question 8. Ethical considerations. An insurance agent discovers that their prospective client has a pre-existing medical condition that could significantly affect the premiums. What is the agent's ethical obligation regarding this information? A. To withhold this information to avoid losing the sale. B. To inform the client about the potential impact of their condition on premiums and underwriting. C. To advise the client to seek insurance coverage elsewhere. D. To modify the client's application to present a more favorable view of their health. Answer: B. To inform the client about the potential impact of their condition on premiums and underwriting. Explanation: ethically, the insurance agent must disclose all relevant information regarding the prospective client's health condition and its potential impact on premiums and underwriting. Option B is transparency ensures that the client can make informed decisions about their coverage options. Option is unethical as it prioritizes the agent's interests over the client's needs. Option C is inappropriate because the agent should provide options rather than push the client away. Option D is unethical and could lead to serious legal repercussions for both the agent and the insurance company. Question 9. Rights of beneficiaries. What rights do beneficiaries have under a term life insurance policy when the insured passes away? A. The right to access the insured's medical records to validate claims. B. The right to change the policy terms after the insured's death. C. The right to receive the death benefit upon filing a valid claim regardless of any outstanding premiums. D. The right to contest the selection of a primary beneficiary if they are not satisfied. Answer: C. The right to receive the death benefit upon filing a valid claim, regardless of any outstanding premiums. Explanation: beneficiaries have the right to receive the death benefit upon the filing of a valid claim, even if there are outstanding premiums owed on the policy at the time of the insured's death. Option C. The insurer will typically deduct any unpaid premiums from the death benefit, but the beneficiary is still entitled to receive the benefit. Option is incorrect because beneficiaries do not have automatic access to the insured's medical records and insurers handle privacy concerns. Option B is also false, as beneficiaries cannot change policy terms posthumously. Option D is misleading, and while a beneficiary can contest designations under certain conditions, their rights to benefits remain intact as stated in the policy. Question 10. Financial aspects. Which of the following statements about the tax implications of term life insurance is true? A. The death benefit is taxable as income to the beneficiary. B. Premiums paid for term life insurance are tax deductible for the policyholder. C. Proceeds from a policy loan are not taxable unless the policy is surrendered. D. The cash value accumulation in a term policy is subject to capital gains tax. Answer: C. Proceeds from a policy loan are not taxable unless the policy is surrendered. Explanation: proceeds from a policy loan are typically not taxable unless the policy is surrendered. Option C. Loans against the policy do not trigger a tax event until there is a lapse or surrender of the policy, at which point the loan amount exceeding the premiums paid may be subject to taxation. Option O is incorrect because life insurance death benefits are generally received tax-free by beneficiaries. Option B is misleading, and premiums for personal life insurance are not tax deductible. Option D is false because term life insurance policies do not accumulate cash value, and thus capital gains tax does not apply. Question 11. Underwriting process. In the underwriting process for term life insurance, which factor is generally considered least impactful on premium determination? A. The applicant's credit score. B. The applicant's medical history. C. The applicant's occupation. D. The applicant's lifestyle choices, such as smoking or drinking. Answer A. The applicant's credit score. Explanation: while all listed factors can influence the underwriting decision, the applicant's credit score, option A, is typically considered less impactful compared to medical history, occupation, and lifestyle choices. Medical history provides direct insight into health risks that could affect mortality. Occupation can also present specific risks, especially if it involves hazardous work. Lifestyle choices, particularly smoking or excessive drinking, significantly impact life expectancy and thus premiums. While insurers may use credit scores as part of their risk assessment, they are generally not as critical as the other factors. Question 12. Types of term policies. Which type of term life insurance policy typically provides a decreasing death benefit that correlates with a mortgage repayment schedule? A. Level term insurance. B. Renewable term insurance. C. Decreasing term insurance. D. Convertible term insurance. Answer: C. Decreasing term insurance. Explanation: decreasing term insurance, option C, is specifically designed to provide a death benefit that decreases over time, often in alignment with a mortgage balance. This policy is particularly useful for borrowers who want life insurance to cover their outstanding mortgage debt in the event of their death. Level term insurance maintains a constant death benefit. Renewable term insurance allows renewal of the policy at the end of the term, and convertible term insurance allows conversion to a permanent policy but does not imply a decreasing benefit. Question 13. Claims process. Which of the following is not typically required when filing a death claim for a term life insurance policy? A. The original policy document. B. A completed claim form. C. The insured's social security number. D. A medical examination report. Answer: D. A medical examination report. Explanation: when filing a death claim for a term life insurance policy, the claimant typically needs the original policy document, option A, a completed claim form, option B, and the insured's social security number, option C. However, a medical examination report, option D, is usually not required at the time of claim filing unless the insurer needs to investigate further due to unusual circumstances surrounding the death. The standard process relies on documentation related to the policy and the insured's identity rather than a medical exam. Question 14. Policyholder's rights. If a policyholder wishes to change the beneficiary designation of a term life insurance policy, which of the following statements is generally true? A. The change must be approved by the insurer before it is effective. B. The policyholder can only change beneficiaries during the annual renewal period. C. The policyholder must notify the current beneficiary before making a change. D. The policyholder can change the beneficiary designation at any time as long as they are alive and mentally competent. Answer: D. The policyholder can change the beneficiary designation at any time as long as they are alive and mentally competent. Explanation: a policyholder typically retains the right to change the beneficiary designation at any time while they are alive and mentally competent. Option D. This can often be done by submitting a written request to the insurer without needing the current beneficiary's consent. Option A is incorrect. While the insurer must be notified, they do not need to approve the change before it takes effect. Option B is false, as there are generally no restrictions on changing beneficiaries tied to renewal periods. Option C is misleading. While it may be advisable to inform current beneficiaries, it is not a requirement. Question 15. Financial aspects. When considering the cost comparison between term and permanent life insurance, which of the following is generally true? A. Term life insurance premiums are typically lower than those for permanent insurance due to lack of cash value. B. Permanent life insurance is more cost-effective for younger applicants compared to term insurance. C. The death benefit of permanent life insurance is generally lower than that of term insurance. D. The premiums for term life insurance increase annually as the insured ages. Answer A. Term life insurance premiums are typically lower than those for permanent insurance due to a lack of cash value. Explanation: term life insurance premiums, option A, are usually significantly lower than those of permanent insurance because term policies do not accumulate cash value and are intended to provide coverage for a specific period. Option B is incorrect, as term insurance is often more cost-effective for younger applicants due to low mortality risk. Option C is also misleading. While the death benefit can vary, permanent policies usually have higher initial death benefits. Option D is incorrect. Typically, term life insurance premiums are level for the duration of the term and can increase upon renewal. Question 16. Scenario-based question. Mr. Adams has a 20-year level term life insurance policy. He is diagnosed with a serious illness after 10 years and fears he may not be able to maintain the premiums. What options should Mr. Adams consider to ensure his family's financial protection? A. He should let the policy lapse, as there are no alternatives available for him now. B. He can consider converting his term policy to a permanent policy if it has a conversion option. C. He should take a policy loan to cover his premiums, as this will not affect his coverage. D. He should reduce the death benefit to lower his premiums without affecting coverage duration. Answer B. He can consider converting his term policy to a permanent policy if it has a conversion option. Explanation: Mr. Adams should consider option B, as many term policies include a conversion option that allows him to convert to a permanent policy without additional underwriting, which would be crucial given his recent diagnosis. Option A is not advisable, as it would leave his family unprotected. Option C is misleading. While a policy loan can cover premiums, it will reduce the death benefit, and any unpaid loan amount at death will be deducted from the benefit. Option D is incorrect. Reducing the death benefit may not alleviate the financial strain significantly and can jeopardize the policy's intended purpose. Question 17. Current trends. Which of the following statements regarding current trends in the life insurance market is accurate? A. There is a decreasing interest in term life insurance products among consumers. B. The use of technology in underwriting has no significant impact on the insurance process. C. Consumers are increasingly seeking life insurance products that offer flexibility and customization. D. Economic downturns have little effect on life insurance sales. Answer: C. Consumers are increasingly seeking life insurance products that offer flexibility and customization. Explanation: consumers today are showing a growing interest in life insurance products that offer flexibility and customization. Option C. This trend reflects a desire for policies that can adapt to changing needs, such as adjustable premiums and benefits. Option A is misleading, as term life insurance remains popular, especially for its affordability. Option B is incorrect. Technology and underwriting significantly enhances efficiency and accuracy in risk assessment. Option D is also incorrect. Economic downturns typically lead to decreased sales, as consumers may prioritize immediate financial needs over life insurance. Question 18. Prohibited practices. Which of the following practices would be considered a violation of ethical standards in life insurance sales? A. Providing the client with accurate information about policy features and costs. B. Using high-pressure sales tactics to persuade a client to purchase insurance. C. Offering clients the option to compare different policies. D. Disclosing all relevant exclusions and limitations of a policy. Answer: B. Using high-pressure sales tactics to persuade a client to purchase insurance. Explanation: Using high-pressure sales tactics, option B, is unethical and can lead to violations of consumer protection laws. Ethical sales practices involve providing clients with accurate information and allowing them to make informed decisions without undue pressure. Option A describes a standard ethical practice, and option C encourages transparency, both of which are important in ethical sales. Option D is also ethical, as full disclosure of exclusions and limitations is required for informed consent. Question 19. Ethical considerations in selling. An insurance agent learns that a client is considering purchasing a life insurance policy based on misleading information from another agent. What is the agent's ethical obligation in this situation? A. To ignore the misinformation and allow the client to make their own decision. B. To confront the other agent directly about their misleading practices. C. To provide the client with accurate information and clarify any misconceptions. D. To dissuade the client from purchasing life insurance altogether. Answer: C. To provide the client with accurate information and clarify any misconceptions. Explanation: The agent's ethical obligation, option C, is to ensure that the client is fully informed by providing accurate information and clarifying any misconceptions. It is important to maintain professionalism and integrity in the industry. Option is irresponsible, as it neglects the agent's duty to protect the client's interests. Option B may not be appropriate in a professional setting, and the focus should be on helping the client rather than confronting another agent. Option D is incorrect. The agent should support clients in making informed choices rather than dissuading them without justification. Question 20. Risk classification. Which of the following best describes the impact of risk classification on life insurance premiums? A. High-risk classifications lead to lower premiums as they indicate better health. B. Low-risk classifications generally result in higher premiums due to increased mortality risk. C. High-risk classifications result in higher premiums due to increased mortality risk. D. Risk classifications have no significant impact on premium pricing. Answer: C. High-risk classifications result in higher premiums due to increased mortality risk. Explanation: High-risk classifications, option C, indicate a greater likelihood of a claim being made due to health issues, lifestyle choices, or other risk factors, which leads to higher premiums. Low-risk classifications generally correspond with lower premiums since they indicate better health and a lower likelihood of claims. Option A is incorrect. The high-risk classifications do not correlate with lower premiums. Option B is misleading. Low-risk classifications typically result in lower premiums, not higher. Option D is also incorrect, as risk classification is a fundamental factor in determining premium pricing in life insurance. Question 21. Types of term policies. Which of the following term life insurance policies provides coverage that decreases in value over time? A. Level term. B. Renewable term. C. Decreasing term. D. Convertible term. Answer: C. Decreasing term. Explanation: Decreasing term insurance, option C, is designed to provide a death benefit that reduces over time, typically in line with a mortgage or another financial obligation. Level term, option A, maintains the same death benefit throughout the term. Renewable term, option B, allows the policyholder to renew at the end of the term without needing to. Or qualifying convertible term, option D, permits the policyholder to convert to a permanent policy without medical underwriting. Question 22. Claims process. What is the primary purpose of the contestability period in a life insurance policy? A. To allow the insurer to adjust premiums during the policy term. B. To provide the insurer time to investigate claims made by beneficiaries. C. To allow the policyholder to cancel the policy without penalty. D. To allow the insurer to contest a claim if misrepresentation is found within the first 2 years. Answer: D. To allow the insurer to contest a claim if misrepresentation is found within the first 2 years. Explanation: the contestability period, option D, is typically the first 2 years of a policy during which the insurer can investigate and deny a claim based on misrepresentation or fraud. Option A is incorrect as the contestability period does not pertain to premium adjustments. Option B, while true that insurers may investigate claims, the contestability period is specifically about misrepresentation. Option C is also incorrect. The cancellation of the policy is governed by other provisions. Question 23. Ownership rights. Which of the following best describes the ownership rights of a policyholder in a term life insurance policy? A. The policyholder can transfer ownership without the consent of the beneficiary. B. The policyholder has no rights to change beneficiaries once designated. C. The policyholder can only access the cash value of the policy. D. The policyholder must have the beneficiary's consent to change ownership. Answer A. The policyholder can transfer ownership without the consent of the beneficiary. Explanation: in term life insurance, the policyholder, option A, can transfer ownership of the policy to another individual or entity without needing consent from the beneficiaries. Option B is incorrect. Policyholders can change beneficiaries at any time unless it's designated as irrevocable. Option C is misleading because term policies typically do not accumulate cash value. Option D is also incorrect. The policyholder does not need consent from the beneficiary to change ownership. Question 24. Financial aspects. Which of the following factors most significantly impacts the calculation of life insurance premiums? A. The occupation of the policyholder. B. The policyholder's preferred payment method. C. The geographical location of the policyholder. D. The policyholder's chosen beneficiary. Answer A. The occupation of the policyholder. Explanation: the occupation of the policyholder, option A, significantly impacts the calculation of premiums, as some occupations carry higher risks than others. For example, those in hazardous jobs may face higher premiums. Options B and C can influence premiums to some extent, but are not as significant as occupation. Option D does not impact premium calculation since the beneficiary's identity does not affect the underwriting process. Question 25. Policy features. Which of the following is a feature unique to convertible term policies? A. They can only be renewed at the end of the term. B. They allow conversion to a whole life policy without evidence of insurability. C. They have a decreasing death benefit over time. D. They are typically less expensive than whole life policies throughout their term. Answer B. They allow conversion to a whole life policy without evidence of insurability. Explanation: convertible term policies, option B, provide the unique benefit of allowing the policyholder to convert to a permanent policy such as whole life without needing to provide proof of insurability. Option A is incorrect as convertible policies can often be converted before the term ends. Option C describes a decreasing term policy, not a convertible one. Option D is misleading. While convertible policies may start cheaper, their overall cost can exceed that of whole life policies once converted. Question 26. Consumer protections. Which of the following regulations is designed to protect consumers from unfair practices in life insurance? A. The graded death benefit provision. B. The guaranteed renewability clause. C. The Unfair Trade Practices Act. D. The mortality table regulation. Answer C. The Unfair Trade Practices Act. Explanation: the Unfair Trade Practices Act, option C, is a regulation aimed at protecting consumers from deceptive practices in insurance sales. It encompasses a range of activities deemed unethical, including misrepresentation and false advertising. Option A and B are provisions within life insurance policies, but they do not pertain specifically to consumer protections. Option D refers to regulations regarding mortality tables used for underwriting and is not primarily a consumer protection measure. Question 27. Underwriting process. What is the primary purpose of underwriting in the context of life insurance? A. To set the premium rates based solely on market competition. B. To determine the insurability of an applicant based on risk factors. C. To decide the type of policy the applicant will purchase. D. To review claims submitted by beneficiaries. Answer B. To determine the insurability of an applicant based on risk factors. Explanation: the primary purpose of underwriting, option B, is to evaluate the risk associated with insuring an applicant and determine their insurability based on various factors such as health, lifestyle, and medical history. Option is incorrect. While competition affects pricing, underwriting is more focused on risk assessment. Option C is misleading, as the policy type may be suggested, but it is not the primary function of underwriting. Option D is not correct, as claim reviews occur after underwriting. Question 28. Term life insurance policies. Which of the following is typically true about level term life insurance policies? A. They provide coverage that decreases each year. B. They have a fixed premium that remains the same throughout the policy term. C. They cannot be renewed at the end of the term. D. They only cover accidental deaths. Answer: B. They have a fixed premium that remains the same throughout the policy term. Explanation: level term life insurance policies, option B, maintain a consistent premium and death benefit throughout the life of the policy, making them predictable for the policyholder. Option A describes decreasing term insurance, while option C is incorrect, as many level term policies can be renewed. Option D is also incorrect. Level term policies cover all causes of death, not just accidents. Question 29. Tax implications. Which of the following statements about tax implications on life insurance is correct? A. Death benefits paid to beneficiaries are subject to income tax. B. Cash value accumulation in a whole life policy is tax deferred. C. Policy loans are always taxable upon withdrawal. D. Premiums paid for life insurance are tax deductible for individuals. Answer: B. Cash value accumulation in a whole life policy is tax deferred. Explanation: in life insurance, cash value accumulation, option B, in a whole life policy is tax deferred until withdrawn. Option A is incorrect. Death benefits are generally not subject to income tax. Option C is misleading. Policy loans are not taxable unless the policy is surrendered. Option D is incorrect. Premiums paid for life insurance are not tax deductible for individuals except in certain business situations. Question 30. Practical applications. Mr. Thompson, a 45-year-old father of two, is considering a term life insurance policy to secure his family's financial future. He is debating between a 20-year level term policy and a 30-year decreasing term policy. What should Mr. Thompson consider when making his decision? A. The decreasing term policy will provide greater coverage at a lower cost over time. B. A level term policy will offer consistent premiums and a steady death benefit throughout the term. C. The 30-year policy will likely have low premiums than a 20-year policy. D. The term length does not impact the total cost of the policy. Answer: B. A level term policy will offer consistent premiums and a steady death benefit throughout the term. Explanation: Mr. Thompson should consider option B, that a 20-year level term policy provides predictable premiums and a death benefit that remains constant, ensuring financial protection for his family for the full term. Option A is misleading. While a decreasing term may initially seem cheaper, it provides less coverage over time, which may not adequately protect his family's needs. Option C is generally incorrect. Longer term policies typically have higher premiums. Option D is also false, as the term length significantly impacts the total cost of the policy, particularly in how premiums are structured.